Welcome to the Connecting to Reimagine webinar. Today, we are going to talk about debt management and financial security. Even before the pandemic, we saw that debt was rising and that people were bringing debt close to and into retirement. This means that we need to start rethinking about debt, retirement, and also management of wealth into retirement. I have the pleasure of working with a world expert on retirement. And when we started looking at these issues some years ago, we couldn't finish just addressing this topic well enough just by writing a few papers. And we ended up editing a book about this topic. It was published last fall by Oxford University Press. It is called Remaking Retirement, Debt in an Aging Economy. It has 12 chapters, and so we were able to ask other experts as well to write about this important topic, and we cover from debt to financial fragility related to debt to policy perspectives about debt. I know that it is hard to summarize a book, but let me turn to Olivia that together with me has been editing the book and really led this project. We had a wonderful conference at Wharton a year ago. So can you summarize the main findings about this book?
With pleasure. Thank you so much, Annamaria, for including me in this event. The purpose of our book was to focus on what we saw as an increasingly important development in this aging world, namely the fact that people nearing and entering retirement are holding ever greater levels of debt than in the past. We saw this as quite a worrisome development because older people frequently have fewer degrees of freedom to rectify their financial shortfalls. And also increasing numbers of both pre-retirees and retirees themselves are quite concerned over their indebtedness, reporting stress and financial fragility. Finally, in the future, debt among the older population may render retirees even more vulnerable to financial shocks, high medical bills, and of course, changes in interest rates. Now, I should point out that our book was written before the pandemic. So these findings do relate to prior to the COVID-19 virus, but many of them are actually exacerbated or carrying forward during this period. Just to summarize a couple of the key takeaways, one of the things that we learned was that older people with high levels of debt, and especially high levels of debt to income ratios, are going to be potentially in trouble. For example, many older homeowners may face the loss of their homes when and if interest rates rise. One reason we came to this state of affairs is that the long, low interest rate policy has induced people to borrow more, including financing and refinancing expensive homes. And then on the other side, many older people are not financially sophisticated. So they do tend to make numerous mistakes when borrowing and trying to pay for debt.
In the book, we cover a lot the experience of the US, and of course, the US, as we witness people bringing that into retirement, including student loan. But there are also a couple of chapters about the experience of other countries. So what's happening there?
Well, it's interesting. We had a very fascinating study on debt in Japan, because Japan is of interest as it has the most rapidly aging population in the world. Somewhat surprisingly, the findings indicated that pre-retirees in Japan did not experience increasing debt over the last 40 years. However, debt to income ratios did rise substantially for prime age Japanese due to rising rates of home purchases among those starting new families. This is in part due to institutional policies that the Japanese government had introduced. They first put in place tax breaks for homeowners. Of course, they also had very low interest rate policies, and they reformed the housing market. All of these factors made it much easier for the young to borrow for their homes. So the implication of this is that debt institutions make a big difference. Finally, turning to more macro implications, there was also some interesting research examining the chances that rising household debt would be associated with higher unemployment, lower economic growth, and even potentially a banking crisis. In fact, this research on 80 countries, cross-national research, found that there is in fact a negative relationship between household debt growth and future GDP growth. So this very much underscores the need for policymakers to closely monitor household debt levels and to take these into account when developing central bank policy. In other words, it's not just the health of banks that we need to focus on, but also the health of household balance sheets.
Well, thank you so much. This is therefore a great time to ask about to comment about this finding. We have invited the CEO of the European Banking Federation. And Wim, what do this finding tells you, and what is the situation in Europe?
Oh, thank you very much, Annamaria. And I would like first to congratulate Professor Mitchell and you with this very interesting book. And I would call upon anybody following this webinar from Europe in the scientific world. I do believe we need more scientific data like this for Europe. But having read the summary, it is clear that there are a number of trends in the book which we can recognize as well in Europe. Not only experiences from the US, but also experiences from Japan. Because we are also in an aging population and an aging continent in Europe, and we expect many of the what they call the baby boomer generation to retire in the coming 10 to 20 years. Interestingly, we expect to have about 500,000 100-year-old people in the continent by 2050, which is good and bad at the same time. It's good that they stay healthy so long, and it's bad if they haven't arranged their pension. And at the same time, 1 in 11 people in Europe will be around 80. So it's not easy to retire, and actually the European welfare system is still adjusting or needs to adjust to this. But there's no doubt that this will have to have the involvement and the consciousness of people as well. I am Dutch, I come from the Netherlands, and the Netherlands is seen as one of the better countries dealing with pensions and retirement age. But if you look at the studies in the Netherlands, it shows that 2 out of 5 people worry about their pension during their working life. That's good in itself because it shows awareness. But 52% do not know how big their pension will be. 45% suggest that they will have a budget shortfall after retiring, and 35% is concerned over a drop in income from retirement age. Again, this is for the Netherlands. And if you look at the Netherlands, and the years where I go to Japan as well, in the Netherlands, you can also have a so-called interest-only mortgage. So in that sense, you take your mortgage up to retirement. And I personally always have big problems with the fiscal incentives of indebtedness that are built into this system. It is indeed at such a level that the Dutch central bank has called on a number of times on banks to reduce the level of mortgage indebtedness, because indeed it then becomes a problem for financial stability as well. So all in all, I do see the trend of the graying of debt. I do see that the elderly are taking more and more debt into their retirement, and at the same time they're aging, they're getting older. So there is a real reason to address these issues.
So let's actually turn to that. And Olivia, we see that a lot of programs, for example, cover savings and managing savings, but there is not as much attention to debt and debt management. So what can we say about this? And if we have to reimagine how we think about retirement, and if we have to reimagine the future even after this pandemic, what would be some of the recommendations for example, stemming from the book, your research, and both the data and what we see in the US and around the world?
Well, one of the key things to point to is the fact that older people are now entering retirement without paying off their mortgage. Back in the old days, 30 years ago, you had to pay off your mortgage. This was almost a social norm. But now older people have purchased more and more expensive homes, leaving them in greater debt. And on top of which, they have more credit card debt and student loans as well. I understand that around 6% of Social Security beneficiaries are having their benefit checks garnished or cut because they haven't repaid their student loans in full. And so some of it's for their own loans, some of it's for loans they co-signed for their children or their partners. But the reality is this is a very different world that we're in. One response by some people to this rise in debt is to work longer and to retire later. And the impact has been the largest for people with the most debt and with very little in the way of financial assets. The key lesson of this book is that more financial literacy is needed so people can do a better job of managing their assets and their debt on the way into retirement. And so this is a lifelong need. Moreover, people that do a better job managing their debt because they're more financially literate are more resilient in retirement. And during the COVID pandemic, which of course happened after we published the book, we have also found that the least financially literate are the most likely to report feeling financial distress. So to me, the clear implication is that financial education programs could help people avoid such a great debt prior to retirement and could also help retirees struggling to manage their retirement assets and liabilities.
Let me turn to you, Wim. So what are some of the programs that perhaps you have seen in Europe? Europe as well has been, I think, taking up the importance of financial literacy, financial education. And what are your recommendations, in particular for the private sector?
Well, private sector, in my view, as you know, I'm an immense believer that it's the duty to society, not only for the private sector, not only for the public sector, but by working together. And there are some very good examples of public and private sectors, sometimes led by the central bank, sometimes led by the Ministry of Finance, or sometimes led by an independent foundation, to bring everybody together on financial literacy. Because the big takeaway is, of course, absolutely necessary. We need more financial literacy, and we need public-private partnerships. I am a big believer in broad cooperation in society. And again, you yourself, Annamaria, but also the OECD has brought many, many people and groups together discussing this and learning from each other's experience. Again, if I start by the Netherlands, but the Netherlands is certainly not the only country, but just the country that I know best because I was involved in setting up financial education programs there. One of the programs that is important there is the so-called pension 3 days, because on the realization that people need to take care of their own pension in a receding welfare state, and that people have a tendency to postpone thinking about their pension, they have 3 days in which all companies, together with government agencies, so together with pension funds, work together and have all sorts of activities, including individual pension advice. They sit in canteens in companies where people can, with a very low threshold, come and discuss. They do research. That's one part. But then also, and you know that I'm also impressed by the international finance museums. In the past, finance museums tended to be, if I use a diplomatic expression, quite dry. Not so, because in many places of the world, and you know, Annamaria, that I'm a big fan of the Mijs Museum, for instance, in Mexico City, which is one of the best examples, but there are many, many more in Torino, in China, in Canada. And they aim to make financial literacy not only interesting for young people, classroom, but also for the elderly. And sometimes they have such a way, the museum professionals and the educational professionals working there, that they really make it very tangible and available also for the elderly. So there's another, that's the second. And the third one is that I would like to mention a number of programs in Lithuania. For instance, municipalities have a senior hive in which they aim at seniors, again, the municipalities, and they deal with everything, including indebtedness, including retirement provision. In Poland, there is a the trainers module that aims specifically for programs to train trainers for the elderly, to help the elderly or help people in the middle of their life to be ready for their pensions. In Finland, there is a cooperation with senior citizens associations, the same in Sweden, and it goes on. So there are good examples. What I do worry about is two things. The first is that the level of financial literacy is so different per country, and I would like to see a European approach. And but the last thing that is good is that the new Commissioner for Financial Services, Commissioner McGuinness, has explained to me that she is a big believer in financial literacy, so she can expect many visits from me to remind her of the importance.
So I'm so glad to see that so many countries have put in place programs, in particular for the older population, for the elderly. And I think this book really speaks of the need for those programs, and in particular related to debt and debt management. But one of the alarming findings of the book for me is the fact that, for example, in the US, people bring student loan into retirement, and it is often their own student loan, but also the student loan that they are taking up, for example, for a family member or for their children. And so I want to now think a little bit about maybe financial education starting at a younger age, starting, for example, in school, so that people can make an informed decisions about this very important and consequential decision they are making about, whether or not to continue their education and how to support that education. So let me start with, again, with you, Olivia, about financial education for the young. What is your view, and what do you think we can do both in the US and maybe, some suggestion for other countries as well?
Well, as you know, Anna, I'm very partial to the idea of the Bank of Mom, which is a spreadsheet that I set up for my two daughters when they were young. And they got a very small allowance. And if they wanted to, they could do some extra chores, and that would boost their allowance. And then if they wanted something, they had to spend from the Bank of Mom. So in some sense, really financial literacy needs to begin at home. But we're very aware that not every parent, not every home situation is conducive to financial literacy at home, which is where I think schools have a very large responsibility. There have been a number of recent meta-analyses, that is, studies across a great wide range of research trying to pull out the key lessons. And I think it's very clear that there's growing evidence that high school personal financial education requirements are critically important in reducing student loans, in helping boost young adults' credit scores, lowering interest rates that students do borrow at when they take out student loans. The financial education also enhances loan repayment rates, and there are many other positive financial behaviors. Moreover, in some of our own early research, what we found was that young people that went to high school in states that had mandatory financial literacy requirements did better in terms of planning for retirement after they graduated. So it's clear that there's a profound impact on this. Moreover, there's very little evidence to date on how quickly this knowledge decays, but we do need to have more information on that. More research is needed. There's also, and I'll put out a call to some of your work on a nice new NBER working paper that reports on a meta-analysis of almost 80 randomized controlled experimental studies on the impact of financial education on financial outcomes. And looking across 33 countries and hundreds of thousands of people, this really confirms and extends the conclusion that financial education is critical for young people.
I want to repeat that financial education does work and it's critical for young people. Is it true, Wim? What is your evidence? I know you started your career as a teacher and that you have a passion in particular about financial education for children. So tell us more about that and tell us more about the programs that you yourself and the European Banking Federation and other countries have done about financial literacy for, starting very early for the youth and for children.
Thank you very much, Anna. Indeed, I am absolutely passionate. And indeed, as both of you will probably know, if you start as a teacher, it will never leave you again. It will be with you for life. And it's the same with me. And we stood together, Annamaria, on many stages explaining that financial education is a life skill. You need to know about money if you want to have a successful life. And otherwise, actually, you get all sorts of social divide because indeed it starts at home. But of course, more privileged children will have more chance of learning from their parents. So it is really a social duty for all of us. Having said that, there's even more going on because money has become totally virtual. I realized that I still have, for the last 2 months, the same cash in my pocket as I had 2 months ago. That's because I just put my phone to a machine and the money is gone. But with money virtual, it becomes more important that you realize the value of money and how you need to manage it. At the same time, you also see when children go into young adults, that they need to save earlier. They need to save for a more successful life. And indeed, if they have the skills learned at school, there is indeed evidence that this is successful, and a lot of research was done into that. So in the Netherlands, I was indeed very active in the so-called Money Week and the public-private partnership MoneyWise, in which we stood in front of a class. But mostly we developed tools for teachers to use. Because indeed, what we never wanted to do was tell teachers how to teach, but we wanted to give them tools which they could use in their lessons. And I always especially enjoyed teaching to 10 to 12-year-olds who wanted to know a little bit about money, but mostly about bank robberies, to be honest. But I can talk about that as well. So what we developed at European level, together with all the partners, is the European Money Week, which is a central moment that we choose, in which all the countries can bring their expertise. But I think more importantly, we created an ecosystem, a platform in which we can help each other come up with best practices. And this has worked, for instance, very well with countries like Syria and Albania, who could use the practice and adapt it for their own country and also create their own financial education program. And I'm also particularly proud of the European Money Quiz, which was a huge effort to translate, to find a computer platform, but also to translate in many languages the right questions, and then not only have national finals, but also have 60 children play in the European finals. And again, the amount of energy that this gave was important. Lastly, I would like to say, through financial education programs for children, and even if you do simple giveaways or quizzes or games, we also found that this would reach the parents, because in the evening at the dinner table, the talk would be about the lesson of today. And with that, there would be an interest by parents as well. So indeed, I'm a big believer, and I will indeed continue to passionately fight for financial education programs for children wherever.
Thank you so much, Wim. We can hear and we can feel your passion for this topic, and I think that all of us share this passion because it's so fundamental, in particular for our young. We teach at the university, we see young people, and we see what are the consequences actually of financial literacy and education for their future. I cannot resist asking this last question to each of you, because not only we are in the middle of a pandemic, so that's also the reason to say, you know, we can reimagine the future, and we might need to do so because, you know, the world is changing in front of us, and it gives us also an opportunity to stop and think about, you know, what this future can be. But in addition, we have a new administration here in the US. So can I ask each of you to provide some policy recommendations or some general recommendations about, you know, reimagining the future, indeed, in particular related to this problem of managing debt. And, you know, now not just individual, but the governments as well are taking up more debt. So that is becoming the new normal, I'm afraid, in the future. Let me start with you, Olivia.
Well, thank you. I am delighted to offer suggestions to the new administration. Obviously, first and foremost has to be to stop the pandemic and get people vaccinated and do it quickly. But related to that is we have to push the stimulus bills hard. People were already financially fragile pre-COVID, and there are many of them, millions of them, in much worse shape now. In fact, it goes beyond this because people will be poorer for the next 40 to 50 years due to the huge national debt that they will be paying back. And this, I think, constricts the opportunity for fiscal and monetary policy in the event of a new shock. But ultimately, I agree with Wim that public-private partnerships are more important now than ever. And I think back, I'm old enough that I remember John F. Kennedy's 1963 effort to encourage physical fitness. This was a huge national public policy campaign, which was extensive, it was media savvy, it was national in scope, and it got kids to do exercise, which had never been done on a national basis previously. They had television, print, radio, advertising material. They sent out this across the country and continually encouraged public relations outlets. In fact, this was such a national popular movement that it even appeared on the Peanuts cartoon by Charles Schulz, because everybody took up the cause. This is what I would hope the Biden administration could turn to, but with financial literacy as well.
This is a great suggestion. This is a great program. We need to think about our financial health, not just our fitness. And Wim, how about you? What are your recommendations?
Well, indeed, it's slightly off topic, but I would like to echo Olivia's recommendation to vaccinate and vaccinate quickly. Thank you very much. So the governments have something to do there in Europe. Having said that, indeed, what is true, and the pandemic brings everything to a cliff edge, because we are accumulating debt for generations to come, and the young people of today will have to pay this off. And indeed, it is, of course, I do believe that many of the governments reacted in the right way by supporting the economy, but they have to realize the end of the crisis and the accumulated debt as well. And I completely agree that this will lead to less resilience in case of an other shock. So I am absolutely believed in national programs. As you know, I am a deep believer in public-private partnerships because I do believe that it is a social duty of private companies and public authorities to work closely together, to leave the roles behind and make sure that we can combine. And there is what I call then is the European Commission, again, Commissioner McGuinness, has a personal interest in financial education. I have had many discussions because in Europe, this of course may be a question of subsidiarity. And always the question is what should be done at European level and what should be done on member state level. I can only say that really brilliant things that I've seen have been done at member state level. And there are so many creative educators. And this is an ecosystem that has been built over many years and of which you have been a part, Annamaria, for many years. So what I do ask of the European Commission is not to regulate. It's not to put subsidy or money in it. But the European Commission has an incredible capacity to bring people together under their leadership. So that's what I would like to ask. is don't try to reinvent the wheel, but bring and unite people together in this huge challenge that we have.
Thank you so much. It's time now to start turning to the questions, and I think we actually perfectly hit the mark. We wanted to spend the first half an hour discussing some of this topic, but I can tell you there are so many questions coming in, and I would like to collect them together because it's very difficult to answer all of these questions. So there are some technical questions, Olivia. I would like to address them to you. The first one is, let's talk a little bit more about the heterogeneity in this data, and in particular, what about women? What about, racial differences? And that's a clearly important topic. And what can we say about that? The other thing is related to what you illustrated very well, and people are already arguing, but is there an optimal level of debt? Some of this debt can be high because it's optimal to do so. People are using all the incentives. What is, in a sense, the right amount of debt? And I know it's hard to answer these questions, but we illustrate some of these things in some of our work. So let me actually start with that.
Thanks, Anna. The question about how much is the optimal level of debt depends quite a bit on things like people's risk aversion and their preferences for consumption today versus the future. So it's not like there's a one-size-fits-all answer. It also, as I mentioned earlier, depends on the institutions in the country that you're living in. For example, one reason it is said that many people in the US took out mortgages for increasingly expensive homes was that the mortgages were permitted with no money down, and people just thought that it was free money. Another thing that's true is that in many states in the US, if you take out a home mortgage, but you don't want to pay it back or you can't pay it back, the mortgage is a non-recourse loan. That means you can walk away from the house, drop the keys in the mailbox, and you will never be required to pay back that mortgage. That's an institutional reality, which encourages people to buy and take out more and more debt. So that's, I think, a key factor. Now, with respect to the point about women and racial minorities, much of our research has shown that women, pretty much in every country around the world that we've looked at, women are less financially literate, and systematically so. Now, the good news is that women are willing to admit that they're not financially literate. So that in a sense, they're teachable. They can reach out and ask for help. Whereas the men, on average, are more financially literate, but they're much more confident, even when they're not literate. So it's a little bit of a more difficult matter to be able to teach that group. And the other thing we found is that debt has become an even bigger problem, especially for African Americans in the US, partly because they started with fewer assets, but also partly because as a group, many of them are not financially literate and end up taking payday loans, rent to own arrangements, and the kinds of expensive high cost debt that ends up spiraling downhill.
Let me turn to a question specifically to you, Wim, about educating the youth, and this is something I'm also considering and thinking a little bit about. What do you think is the role of social media? Perhaps can also social media be used or to engage the youth and so on? Do you have some experience to bring here?
Yeah, well, what I found beautiful is, if I take the example of the European Money Quiz, we could have never have done it except for the Kahoot platform. And the Kahoot platform is a gaming platform it was designed as an educational platform, and you can do any quiz. Everything is gamified. So you can do a history test on there, or a sports test, or a financial education test, and it is gamified. It becomes interesting. It becomes there is a competition element to it, and that gives a direct answer to your question. I think that social media are essential in reaching the young, but it it can be served in a way that it is attractive and interesting. So again, it's the same that goes for normal education. If you do not serve it in a way that attracts the audience, you will not reach that audience.
Mm-hmm.
This is a new topic, but I know, Olivia and both Wim, that you have probably seen it. What's the role of fintech? Can fintech help people manage that? What do you see? What do you see here? If you can maybe give some insight on this topic. I'm going to ask this question to both of you.
Well, I would just start by saying that we sponsored a conference and published a book also at Oxford University Press on how fintech is affecting retirement. And what we found, and I also taught a course this last semester on consumer financial decision making, and many of our students reviewed some of the fintech platforms. What we found is that the fintech platforms, by and large, are pretty confusing. They don't often tell you how they make money. And what they do focus on is young people. So they try to get you to save, they try to get you to invest. But most of the fintech platforms did a very poor job, if any job at all, on the retirement phase of life. So they didn't help you, for example, figure out when should you claim your Social Security benefits. That has an enormous impact on your lifetime income stream. They didn't talk to you about debts going into retirement or what the order of withdrawal should be from different accounts if you have a couple of different types of savings accounts or pensions. So my view is that fintech has a long way to go before it can really help this retirement population beset by debt.
Would you like to say something about this as well, Wim?
Well, yes, I have a positive. I have the concerns, similar concerns to Olivia. I also have a nice positive experience with a fintech who was into saving. And one of the things that I love is that if you spend money from that savings account, it depicted your money as a pile of dollars. And once you spend something, you saw a number of your dollars burn, which I thought was very, very visual and was very good. But having said that, I have concerns as well, because financial services are heavily regulated, and that is for a good reason. There is a high level of consumer protection. There is a high level of forced transparency, because indeed a mistake at an early age, because it has such a long fuse, the explosion happens many years later. So if you ever make a mistake in your 30s in an investment plan, you may be hit when you're 50 or 60, and this is something very serious. And I found that many of the fintechs offer sometimes very smart solutions, but still lack the maturity and also sometimes the regulatory environment in which they are forced to show the long-term effects, including retirement. So indeed, I agree with Olivia that it is attractive and it will come, because there are many, I would say, there are all many advantages, for instance, about the approachability of some of these fintechs. But the other part of the coin is that it is sometimes very untransparent what happens when.
There is a question here. I'm combining a few questions as well, and it's directly directed to you, Wim, but we can elaborate further, and I want to also ask Olivia a related question. One is basically asking, so should banks, for example, prevent and not have people get into retirement with that? You had mentioned, so should we avoid doing so? And to make the question, I think, a little bit bigger, some other people ask, what are some good suggestions, in particular now, about how people should manage their personal finances, right? People are worried that, well, if people pay off debt now, then they might not have a precautionary saving, and they might end up in trouble in other ways. So the question is, first of all, is it bad to have people bringing debt into retirement? Should we try to prevent it, and in particular for banks and related to banks? And what are some of the suggestions and best practices that you can recommend?
Well, in my view, banks should be careful that they are not governments or paternalistic. They are service providers, but they are also risk management. So they should not let people run in over indebtedness. They can, of course, give a loan. But if you look at it, and if I think of a campaign in the Netherlands that makes me smile, is because of fiscal stimulation, many banks sold this interest-only mortgages for many years. And of course, now in a joint effort with the central bank, there are all sorts of campaigns of warning people that an interest-only loan at the end will have to be paid off in full. And that shows, I think, the responsibility that a bank has towards its clients to warn them. I think that the start is, again, going back, that a bank is not a government, it's a service provider, but it has a responsibility. The first start is, of course, that I worry about, and this happens everywhere in the world, is the fiscal stimulation of debt. There is relatively high taxes on savings, and there is a lot of stimulation and on fiscal stimulation on debt. So this is where it starts, and in my view, this is also where the Dutch mortgage problem comes from originally. Having said that, it is hard to say if a bank should refuse or stop, because again, you can imagine that this may also lead to a redlining, discrimination of certain age groups, etc. And I think that banks should be very careful. Having said that, they have the legal responsibility to warn their clients of over-indebtedness and if people take loans too high. So there are rules, but again, you see that this is the balancing where I feel that banks should be responsible risk managers, but should not sit either on the seat of the client or on the seat of government.
I think that's a very well put comment. And I would like to add one additional thought into the conversation, which is that we know financial literacy is essential in helping people make proper financial decisions. But a second factor comes into play as people move through retirement. And this is the phenomenon known as cognitive aging, that we understand from a host of different studies that people, as they age, are likely to experience a decline in their cognitive function. It's different from financial literacy, from the research that I've been reading, but it does imply that financial institutions and regulators need to take a good look at clients, customers' cognitive aging when they make consequential financial decisions. And now in the US, many bank tellers have been trained that when someone comes in who's withdrawing $60,000 and doesn't really seem to be quite with it and is planning to send it to somebody that she met online, that there needs to be a second in command to whom the bank or the bank teller could go to check, do you know your mother is withdrawing money and sending it to wherever? So I think that that's kind of a very key topic that we have to pay attention to increasingly, since we're living longer, but many more of us, especially after some age, 85 or something, are going to be facing dementia. And that is a big concern in this day and age.
And that is a very important comment. And it is always, I know many bank employees who've known their clients for years and who are very, very clear in giving this kind of advice. The problem is, if you sometimes call family members, sometimes you get a very grateful son or daughter, and sometimes you get incredibly, incredibly angry, because you have to be very clear that you're still handling with an adult who may have all sorts of reasons dealing with their personal money. So this is a dilemma. Although I do agree that we need to be very, very careful about it, and we do in a certain way, for instance, with driving licenses, because we know that if we don't, we get serious accidents, and the same goes for finance. If we don't care and don't realize what's happening, we get serious accidents.
Thank you so much. Unfortunately, this is all the time we have for questions. And I know there are a lot of other questions here, but I'm going to say some of the answers are provided in this book. Some people are asking where can we buy this book. It's published by Oxford University Press, but is also available on Amazon. And it provides a lot, of data overview of debt close to retirement, not just data in the US, but also examining the experience of other countries and also looking at the policy perspective. Also, some people are asking us, will this webinar be recorded? It is, and it will be posted again on our website, so you can see it again afterwards. And just unfortunately, we are up to our time. It has been a pleasure to have Olivia and Wim here with us. Thank you again for your contribution. Thank you again for the work you do in both providing not only research, but also solution to this important issue of debt and debt management and financial security. I like some of the idea that you have mentioned. We need financial fitness, and we need to be able to drive our financial life without too many accidents. And with that, thank you again for being here today. And thank you for all of the participants. And we look forward to having you in our next webinar. Thank you.
Thank you.
Thank you.